All right.
All right, welcome, class. It's pretty fascinating when you think about it. We have two countries, the United States and Canada, sharing the longest border in the world, and yet their approach to something as basic as taxes couldn't be more different. So today, we're going to dive into this tale of two tax systems. We'll look at their philosophies, their priorities, and what it all means for the people living there.
So, here's our roadmap. We'll start with the biggest, most fundamental idea, the core principle. Then, we'll get into the stuff that affects most of us, taxing your income and how that funds social services. After that, we'll tackle business taxes, and then the really interesting part, death and departure taxes. By the end, you'll see the whole picture.
Okay, let's jump right in. If you take away only one thing from today, make it this. The single biggest difference, the one that really underpins everything else, all comes down to a very simple question. Who does the country get to tax?
And this is where the paths really diverge. Look at this. The United States taxes you based on your citizenship. Think about that for a second. It doesn't matter where you live. If you're a U.S. citizen living in, say, France or Japan, you still have to file a U.S. tax return on your worldwide income. It's for life. Now, Canada, on the other hand, is like most of the rest of the world. They tax you based on residency. If you live in Canada, you pay Canadian tax. If you pack up and move away permanently, your Canadian tax obligations are generally done. This is a massive, massive difference.
Okay, so we've got that core principle down. Now let's see how that foundation affects the thing most of us care about, personal income tax. How did these two countries actually go about taxing what we earn? So you can really see the different philosophies here. Canada uses what we call a progressive system. The staircase analogy is perfect. The more you earn, the higher the percentage you pay. It's a smooth climb. The US, however, has a bracket system, and the latter analogy is spot on. Your income fills up one rung, or bracket, at a certain tax rate, then it spills into the next rung, which gets taxed at a higher rate, and so on. It's a common mistake people make, thinking their entire income is taxed at their highest bracket rate. Nope, only the money in that bracket is.
Now, let's look at some numbers. This table gives you a rough idea of the federal rates. You can see the ranges for different income levels, but remember what we just talked about. How these numbers are applied is totally different because of that progressive versus bracket system. And this is really important. This is only the federal tax. You have to layer provincial or state taxes on top of this. And those can vary wildly. Some states have no income tax, while some provinces have pretty high rates. So this is just part of the story.
This brings me to a question I get all the time, probably because of some confusion you see online. People ask, wait, does Canada even have a federal tax? I thought it was all provincial.
So let's just bust that myth right now. Yes, absolutely. Canada has both a federal and a provincial income tax. The reason people get confused is that for most of the country, the Canada Revenue Agency, the CRA, is very efficient. They just roll it all into one tax form and one payment. It's all combined. The big exception is Quebec, where you do have to file two separate returns. So yeah, the federal tax is definitely there, it's just bundled up nicely.
Okay, so we're paying all this tax. What's it for? Well, a huge chunk of it goes to social services, and there's no better example of the philosophical divide between the US and Canada than healthcare.
So you can see it laid out here pretty clearly. In Canada, it's a publicly funded system. Your taxes pay for it, and when you go to the doctor, it's generally free at the point of use. You can think of it as one big, government-run insurance plan for everybody. Now, the US is a completely different world. It's mostly a private system based on insurance, which a lot of people get through their jobs. This means what kind of care you get can depend on your insurance plan, and you often have to pay out of pocket for things. And from a tax perspective, this is interesting. In the US, you might be able to deduct some medical expenses. In Canada, well, it's already covered by your taxes.
And that difference in complexity extends to deductions too. I love this analogy. Canada is like a set menu. The system is pretty straightforward, with a smaller number of very specific deductions and credits you can claim. The US, it's a giant buffet. There are deductions and credits for, well, just about everything. Mortgage interest, state taxes, charitable giving, you name it. It offers a lot of options, but wow, can it make filing your taxes complicated.
All right, let's switch gears. We've talked a lot about individuals, but what about businesses? How do corporations get taxed? This is where we see some really interesting stuff happening. So you look at a table like this, and you see the federal rates, the provincial and state rates, and you might think, okay, they look kind of similar. But just like with personal taxes, that headline number, it almost never tells you the real story. The rules behind these numbers, what's deductible, what's not, that's where the real differences are. I love this quote. It's from a US tax lawyer on Reddit talking about the Canadian system, and it just hits the nail on the head. What they're talking about is a technical concept called paid-up capital. But the simple version is this. In Canada, you can sometimes pull money out of your corporation tax-free as a return of your original investment. For a US professional looking at this, it seems, well, like absolute mad lads designed it. It's a fundamental difference from the US system.
And speaking of fundamental differences, let's talk about the flow-through entity. This is a huge concept in the US, especially the LLC, or limited liability company. Here's how it works. The business itself, the LLC, pays no corporate tax. Instead, all the profits just flow through directly to the owner's personal tax returns. It's an incredibly common and popular way to structure a business in the States, but it creates a big problem when Canada gets involved.
And here's the pitfall. This is a huge one. For any Canadian resident looking at a U.S. investment, you have to be so careful. Canada does not recognize the LLC as a flow-through entity. To the Canadian tax authorities, an LLC looks like a corporation. So what happens? You can get hit with double taxation. The income gets treated one way in the U.S. and a completely different way in Canada, and you, the taxpayer, get caught in the middle. It's a classic cross-border trap.
All right, let's move on to the final accounting. What happens when life's journey ends or when you decide to leave a country for good? This is where we get into death and departure taxes, and the approaches here really show you what each country is all about.
The difference here is night and day. The US has an estate tax. This is a tax on the total value of everything you own when you pass away, though there is a very high exemption amount, so it affects very few people. Canada has no estate tax. Instead, they have something called a deemed disposition. It's a clever idea, really. The moment before you die, the government deems you to have sold everything you own. So your estate pays capital gains tax, but only on the growth in your assets, not their total value. Two totally different ways of looking at it.
And this brings us full circle, right back to that first principle we talked about. See how it works? The U.S. has an expatriation tax. It's triggered when a citizen renounces their citizenship. It's all about citizenship. Canada has a departure tax. It's triggered when a resident leaves Canada. It's all about residency. And that departure tax works just like the tax at death. It's a deemed disposition of your assets, so Canada gets to tax the gains before you go.
Okay, we've covered a ton of ground, so let's just boil it down to the key takeaways. What are the big things you need to remember from all this?
First and foremost, the core difference. US tax is based on citizenship. Canada's on residency. That's number one. For individuals, remember the staircase versus the ladder? Canada's progressive system versus the US bracket system. We also saw how these tax systems reflect very different approaches to social services like healthcare. And for businesses, the huge one is that the US concept of a flow-through entity, like an LLC, just doesn't really exist in the same way in Canada. Now, of course, I have to say this is all for your educational understanding. If you have a real tax situation, you absolutely have to talk to a qualified professional.
So I'll leave you with this final question to think about. If a tax system really is a reflection of a country's values, then what do all these differences we've talked about today, what do they really tell us about the United States and Canada? Something to chew on. All right, that's all for today. Class dismissed.